Hey everyone, Danny Lynn here with Freedom Family Investments. In this video, we're going to be talking to you about syndications. You'll love these if you are looking for tax benefits, so make sure you dig in. But stay on till the end because we're going to share with you some stories and experiences from real estate investors who have been working with us over the years so that we can share their experiences with you. Hey everyone, Danny Lynn here with Freedom Family Investments, and in this video, we're going to talk about syndication. First of all, what is a syndication? A syndication is when a group of investors will pool their money to be able to do a larger deal than they could do on their own. This could be in real estate, such as apartments, self-storage, assisted living, industrial. It doesn't matter. It could be anything. It could also be private equity, so for businesses. So a syndication and funds, which is the video I also recorded, all of these, you'll review the PPM, which is the private placement memorandum, to see what the investment is that particular syndication or fund is investing in. So how I'm going to talk about this one right now is actually for a 48 unit that we are actually currently raising for. But this video will serve as an educational video that will likely relate to any syndication that we do in the future. So now that you understand what a syndication is, let's talk about this 48 unit that we have. So we created a syndication. We bought a 48 unit building. We actually closed on it a few months ago, and we are just now finishing the raise for that particular investment. The rate of return is typically, at least on this one, is 12% blended return. Okay? What that means is in this particular investment, you're going to receive 6% paid quarterly, and then you're going to receive 6% accrued upon the exit of the deal. So that could be a refinance, that could be a sale when you get the full 12% blended return. The length of time in syndications is typically 3 to 7 years. The amount earned, let's just say that you invested $100,000, and then at 12%, that means you're going to be making $12,000 for every single year of this investment. Over the life of this particular deal, if it was 5 years, that means over 5 years, you would have made $60,000 on that $100,000 investment. The disbursements, it depends on the syndication. And the one that I'm talking to you about right now, year one, there's no disbursements because that's when all the rehab is happening. And so as the rehab is happening, we're cash flow poor. So a lot of units are vacant. We don't have that cash flow coming in. So we wait for year one and allow all the renovations and the value add to happen. Then in year two, we start paying out 6% in year two. The other 6% that was supposed to be paid in year one actually accrued all the way to the end of the investment. Then the other 6% that accrues the life of the investment continues to accrue. So over the course of the 5 years, whether you got disbursements in year one or not, you still get the full 12% blended return by the end of year 5. Now, this investment could end up refinancing in year 3, and you're able to get your capital back in year 3. It could be year 7. A lot of this depends on the market. When is it a good time to sell? So once we see if the market goes down, we don't want to sell, right? We want to make sure that we're selling at the top of the market. So we'll hold it a little bit longer, watch the market, and then sell it when the time is right. So that's why it says 3 to 7 years, because we're just not quite sure what the market is going to do. We don't have a crystal ball. And so we just let everybody know, just anticipate this is likely how long this investment is going to take. But over the course of time that we are using your capital, you will be receiving a 12% blended return for that entire time. Do you have to be accredited? It depends. On this particular investment that I'm talking about, the answer is yes, but not. Many times we're asked the definition of an accredited investor, or what is the difference between an accredited investor versus a sophisticated investor? Because the SEC can change their guidelines at any given time, we are going to post a screenshot of the current guidelines as of the recording of this video. but we encourage you to go to the SEC's website and check the current guidelines as of the time you are watching this video. One quick tip is to make sure that you're looking for more than just the financial requirements. Being accredited means that you are open to many more investment opportunities. And one way to achieve accredited status is not the financial requirements, but it's simply to pass a test. So check for licensing, check for LLC requirements, or any other additional guidelines that the SEC has provided. Do you have to be accredited? It depends. On this particular investment that I'm talking about, the answer is yes, but not always. I would say most of our syndications, in fact, 90% of them the answer has been no. So there are times where you do not have to be accredited. What is accredited? If you're an individual and you make $200,000 a year or more and you anticipate to make the same next year, then you are accredited. If you're a married couple and you make $300,000 a year or more and you anticipate to do the same next year, you are accredited. Or if you have $1 million of net worth, whether you're individual or married, if you have $1 million of net worth minus your primary residence, that also qualifies you as being accredited. But it just depends on the investment. So anytime we are offering an investment opportunity that is a syndication, you will want to ask, is this for accredited investors or non-accredited? Does it allow compounding? In this particular syndication, no. And in most syndications, no. What is it backed by? It is backed by real estate, but you need to know that you're part of the owners. So you're not a lender. This isn't like you being a bank where a private money lending situation is you're the bank. You're like Bank of America when you're a private money lender. When you're investing in a syndication, you're actually part owner of the entity that owns the property. So it is still backed by real estate. Just understand the difference of you being the bank versus you being the owner. If you have questions, give us a ring. So what does this investment have? Does it have cash flow? It does, as long as we're paying out those disbursements. So this one in particular for this video, cash flow started in year 2. Diversification? No, because this particular one is just a 48-unit apartment. Now, let me say, diversification can be explained by self-diversification, meaning this apartment complex has 48 doors. So you're truly diversified over 48 doors as opposed to a single family house. That's only one tenant, right? One resident that's going to be in there. If it's vacant, you got no cash flow. In this apartment complex, if we have 10 vacant, we still have 38 other doors that are paying us rent. So that's what self-diversification is. However, is it many buildings? No, it's not. So I'm not going to mark off diversification for this, but I wanted to explain the difference. Is it passive? It absolutely is. Is it compounding? It is not. Is it liquid? It is not. So that is an example of a syndication. If you have questions, if you are interested, let me tell you the best part of syndications that I didn't have on this line, because this is the only investment vehicle that is going to do this, tax benefits. So for this particular, it's 2023 when I'm recording this video. Right now, bonus depreciation is allowed to be at 80%. You're going to need to talk to your CPA. This is not the video that I want to explain bonus depreciation. I have other videos where we've talked about it, but let me just say this. 30 to 40% of your investment can be used as a tax benefit. So that means if you invested $100,000, $30,000 to $40,000 is going to be some type of tax benefit to you. So if you pay a lot of money in taxes, this is one of those investments where you're saying, hey, tell me all the investment vehicles that you have that have tax benefits. I want to learn. I want to talk to my CPA, see how that applies to my specific and unique situation. And this is likely where I'm going to put my money. Maybe it's not as liquid. Maybe it's tied up for longer. Maybe it doesn't have as high of a return. Maybe. But if you're paying a bunch in taxes and you need to reduce your tax burden, and that is more valuable to you than the other benefits that other vehicles offer, this is where a lot of people build their wealth because of tax benefits, and they're reducing their tax burden legally through real estate depreciation. The other vehicles do not give this benefit. This is why syndications are so popular for high net worth individuals who have high tax burdens, who have high income careers, and they need to have a way where they can start deducting and getting benefits to reduce their tax burden. So talk to your CPA, call us, ask us any questions that you have, then bring that information to your CPA and allow that person to be able to tell you exactly how it will affect you and your financial situation to see if this is going to be a good fit for you. Again, to contact us to learn more, you're going to go to chatwithfreedom.com. You're going to scroll down to our investor relations team. They have their calendars right there on the website, and you can just choose somebody to talk to, get on their calendar, and then ask them any questions that you have. There's never an obligation to invest. We also did other videos that talk about private money lending. They talk about our master note program. They talk about our income funds. And we also did the syndication video. So watch the other videos, see which investment you feel is best for you. Write down your questions, call our team, and we want to help you on your financial journey because honestly, you're just coming along on the ride with us because we've been on the same path for years. So it's our turn to give back, educate, and help you do the same. And if there's anything that we can do for you, just reach out anytime. Thanks so much, and I'll see you again soon. Well, I hope you enjoyed the video. Now it's time to get real. We're going to share with you some stories from real investors who are going to share their experiences with you so that these examples can come to life. The Syndications provides similar returns but tax benefits. And so we talk to high net worth individuals all the time who have a very high tax burden, and they're looking specifically for wealth preservation, wealth growth, but also how do I reduce my big tax burden? So is that the reason behind syndication investments for you, or can you talk about that a little bit?
Absolutely. I mean, we started, and I think initially, probably for about 2 years or so, I was exclusively working with you with master notes. When I had available money to myself, I'd send it over to you. I mean, and you've been very flexible. One of the things I love is, you don't have any specific opening date, right? It's not, okay, well, March 1st is the next time we can send it over. I mean, there's just random days of the week. I'd say, hey, I got it. Send it over, and it'd start working for me.
Right.
With the syndications, what's nice, and again, that is something where I felt comfortable with the master note. And then again, you're always pulling me and teaching me and helping me, is you say, hey, we have something new here. And when you had your first syndication, I learned about it. We talked, you had a webinar, you sent out a lot of information about it. And that made me feel comfortable with it, which is essentially a shorter term, a couple years maybe, depending on the exact property. With very good returns, equal, sometimes better than a master note. But the key being the depreciation, the K1 coming to you, as opposed to just saying, here's interest income and you're taxed at whatever your tax rate is. I mean, it's I give you money and I pay less taxes and I make money. I mean, it was just win-win.
Our journey in real estate, maybe a little bit different than a lot of other investors. Rather than owning property, I became involved a few years ago in tax liens. And again, quite an interesting curve. I heard the big companies talk about what they offer. In talking with my group of friends and longtime investors, successful business people, I devised some of my own style of tax liens, and in the particular area of tax liens that made the most sense for us. Doing very well. I mean, we were making great money in our investments, and very pleased with that. But there's two things about it. One was, where do you find the deals? And with tax liens, that's a bit of an issue. And the second was the seasonality of it. And I'm adding a third one on here now, which is the record keeping. And my wife's a CPA. She ended up having to step in and help me with the record keeping, which a lot of you watching, you're like, okay, Excel spreadsheets, I got it, easy, click, 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 click. And for me, it's like, one figure at a time. So that's not a good way to do bookkeeping, by the way, one figure at a time. So I was watching all these years, we were watching Flip and Danny, keep in contact with them on Facebook and stuff. We'd watch them, talk about various aspects of the real estate. So a few years ago, one day in the spring, I'm just going to call Flip and Danny and find out what they're doing. And so scheduled a call with Danny, and as she went through these different options, a lot with private money lending, et cetera, she also mentioned, oh yeah, we got this new syndication thing that's coming up. And I'm like, let me hear about this. And she talked about the interest rate return, which sounded great. She talked about the long-term aspect of it, which was awesome because tax lien was all short-term, turn around, make sure that each of the counties were paying us on time and properly, and cut a few errors along the way there. So avoided all that. It's simple. It was long-term. It was truly passive. And for us, that was really exciting because in my consulting, my wife's CPA work, we had plenty of active activities. We weren't bored looking for more, things to do in life. We had plenty of things to do in life. So the passive long-term nature, that was really good. I was really drawn by the fact, the consistency and the predictability of it. I know in 2 years we'll have this, in 5 years we'll have this. We are also with the syndications, the tax benefit was amazing. And we loved that, being able to use that to apply against other passive income. So all of that was a very good fit for us. And so we've been in 2 different syndications. One's closed, came out, and it's like, man, everything's exactly as we thought. We got the money in the bank, our account's grown. And so that was very exciting for us. And so now we still have a combination of syndications and Masternode and debt fund that we went in. It's the consistency and the predictability of it. And it is, for us, I think we have become very focused on the end game. And the end game for everybody is passive income.